Hello everyone, welcome back to the Quant Lab. In our last session, we mapped the market using Fibonacci geometry. But Fibonacci has one glaring vulnerability, subjectivity. If I ask three different traders to draw a Fibonacci retracement, they might pick three different swing lows, resulting in completely different support lines. To eliminate human bias, institutional algorithms rely heavily on pivot points. Pivot points are 100% mathematically deterministic. They project a definitive grid of support and resistance for today using only the raw high, low, and closing prices from yesterday. Because every market participant is looking at exact same daily close, these lines are mathematically identical on every trading terminal in the world. This makes them self-fulfilling pools of institutional liquidity. The classical system calculates a central pivot point, PP, and projects three resistance levels above it, R1, R2, and R3, like this, and three support levels below it, S1, S2, and S3. Algorithms fit the R1 and S1 levels in a choppy market, but target R2 and R3 when a massive macro trend breaks out. The math formulas are listed here. All right. While standard pivots are great, there is a specialized algorithmic variant called the CDP, or Contra-Trend Point system. The structural flaw in standard pivots is that they weigh the high, low, and close equally. The CDP formula fixes this by mathematically giving double weight to yesterday's closing price. Why? Because the closing price is the finalized consensus of institutional capital before the market shuts. It is the single most critical variable for predicting today's immediate volatility. The CDP projects four action boundaries: above high, near low, and below low. And again, the formulas are listed here. This system is explicitly built for mean reversion. It assumes that on 70% of normal trading days, the market lacks the momentum to break out. Therefore, intraday day traders use the NH and NL lines to actively fade the morning momentum. If the stock drops early and touches NL, they buy the dip. If it relaxes early and touches NH, they short it. However, if the price forcefully breaks the extreme AH or AL lines, the mean reversion logic is destroyed. It is a massive breakout, and algorithms immediately switch to a trend following strategy. As quantitative swing traders, we do not day trade the morning chop. We don't actively short the NH line early in the day. Instead, we use the CDP grid during our afternoon golden window as a strict structural confluence filter. For example, if your MACD gives you a beautiful daily buy signal at 3:30 p.m., but the current price is pressing directly into the red NH resistance line. The probability of an algorithmic rejection is extremely high. You veto the trade or wait for a pullback to the central CDP baseline before committing your capital. In the trading app, to see the CDP, you just need to search CDP from these indicators, and then you click it. Then you can see this zigzag lines, okay, curves for all these four levels, resistance and support levels. And that's all for today's lecture. See you in the next lecture.